Let's dive right in. The financial system, well, it's showing some serious signs of strain right now. We're seeing assets move in ways that, frankly, we haven't seen in a very long time. It feels like big changes could be just around the corner. So today, we're going to break down exactly what's happening and what it might mean for all of us.
So here's the big puzzle we need to solve. You've got gold, right? The classic, ancient store of value, and it is on an absolute tear, hitting new high after new high. But then you look at Bitcoin, what everyone calls digital gold, and it seems kind of stuck in the mud. This split, this divergence, it's telling us something really important. The real question is, what?
And this leads us to a massive fundamental question. Is the whole system itself breaking? You see, gold's explosive rally isn't just about Wall Street speculation. It really suggests a global flight to safety. It's a powerful signal that people all over the world might be losing faith in the currencies their governments issue.
And you know, this is not just a US dollar story. Not at all. Gold is hitting all-time highs against currencies all across the globe. It doesn't matter if you're in Iran, China, or Japan. People are flocking to gold because their local currency is just losing its value. It's a crystal clear signal of a global loss of confidence.
So who's doing all this buying? Well, it's not just regular people trying to protect their savings. The most powerful players on the board are also in on the game, the central banks themselves. Just think about that for a second. The very institutions that manage the entire fiat currency system are buying gold to hedge against it. I mean, if that's not the ultimate red flag that something is fundamentally wrong, I don't know what is.
Okay, but let's be real. After a move this big, this explosive, you have to ask yourself, has this whole thing gone too far, too fast? Is the gold market about to slam into a wall?
To really get a handle on the risk here, you've got to look at gold's 14-month Relative Strength Index, the RSI. It's basically a tool that measures market momentum, and what it's telling us right now is just shocking. Gold's momentum is higher at this moment than at any other point in the last 50 years. That's a huge sign that this rally is stretched to a historical extreme.
Now, when an asset gets this stretched, we have a term for it, overbought. The best way to think about it is like a rubber band that's been pulled as far as it can possibly go. It's become incredibly fragile and susceptible to snapping back in a really sharp, sudden price drop.
And this brings us to a classic market signal. You know, when absolutely everyone around you is bullish, when your neighbor who's never invested a dime is suddenly talking about buying silver, that's often the point of maximum risk. This kind of crazy, widespread excitement can come right before a sharp, painful whiplash correction that catches almost everybody completely off guard.
Okay, so let's pivot back to the other side of our puzzle, Bitcoin. If this is all about losing faith in fiat money, why isn't Bitcoin just screaming higher right alongside gold? Well, the answer seems to be caught in this conflict between its long-term story and its short-term behavior. Yeah, here's the paradox. Long-term, the whole argument for Bitcoin is the exact same as it is for gold. Protect yourself from a broken monetary system. But in the short term, right now, they're acting like rivals. As all this big money floods into gold, it seems to be pulling capital away from Bitcoin. It's like, for now, the market is choosing one safe haven over the other. All right, now let's throw a huge wild card into the mix. There's been some serious talk about a potential policy shift in the US that could force the central bank's key interest rate all the way down to 1%. I mean, this wouldn't just be a change. It would be a genuine policy shockwave through the entire system.
I mean, just think about the implications for a minute. Slashing interest rates down to just 1% in an economy that's already growing. That's kind of like pouring rocket fuel on a fire. The obvious, immediate fear is that you get crazy hyperinflation. But what if the market thinks something else is going to happen?
The great thing is, we don't have to just sit here and guess. We can actually look at how the markets are reacting to this very possibility. So let's go see what the so-called smart money in the bond market is telling us.
And what we find is absolutely fascinating. You'd think the threat of a 1% rate would spark a massive inflation panic, right? That would mean investors would be dumping their long-term bonds, which would crush the price of an ETF like TLT. But the exact opposite happened. TLT rallied. And since bond prices go up when investors expect rates to fall, this tells us something incredible. The smart money isn't worried about inflation from this move.
So if it's not inflation, what does the market see? Well, it seems to see a potential really bullish chain reaction. Step 1. Rates fall to 1%. Step 2, that fall accelerates economic growth. Step 3, that growth leads to a surge in corporate profits. And step 4, those profits provide the fuel for another major leg up in the stock market.
So, this leaves every single investor with a huge dilemma. On the one hand, the system is clearly under a lot of pressure, and that's pushing people toward the safety of gold. But on the other hand, a radical policy shift could be about to supercharge the stock market. So what's the real risk here? Is it preparing for a crash that might not even happen? Or is it being left on the sidelines and missing out on the next massive policy-driven rally? That, right there, is the question every single one of us has to answer.